Time for the market report, a slow time of the year.
And also a good time to prepare for the growing season. We'll get into it, but first, the numbers. What were the week's biggest gains and losses? And then some advice from an extension economist on how farmers can help their finances this year. And finally, livestock and row crops. What are the biggest market issues right now? So, markets closed the week in the red, all commodities affected. Let's take a look. The week's biggest gain, live cattle, up about 3.5 cents, an over 1.75% increase from the previous week. The week's biggest loss, lean hogs, down over 3.25 cents, a 4% decrease from the previous week. So, as we said, this time of the year is normal for farmers to shore up their finances to prepare for the coming growing season. Extension Ag economist Dr. Kevin Kim has 2 suggestions for those wondering what would be a good financial move to make right now.
First, let's try to be proactive. So you want to keep a good financial record on a frequent basis. Farm business is a cyclical business. So based on your historical record, you can sort of predict when you're going to incur a lot of expenses at a certain time of the year. So keeping good financial record is always a recommended act to do. Second, if you see some further interest rate cut, you can renegotiate your existing loans and refinance it. That will relieve you from some of the financial burdens that you faced in the previous year. So those will be my recommendations.
Now we get into some big questions all ag economists are asking. What does 2025 look like? What will be the big moves? We start with livestock Dr. Kenny Burdine from the University of Kentucky talking about 4 big questions he thinks are important to the cattle markets right now.
Question 1. Will there be significant heifer retention? Dr. Burdine says that's been in question for the past several years, mostly due to weather, production costs, and interest rates. But this year he predicts, due to favorable market conditions, if weather does improve, then yes, heifer retention should increase. Question 2. Will slaughter weights keep increasing? Dr. Burdine says that's unsure, but based on last year's trend of high beef prices combined with low grain prices leading to cattle weights being pushed to their limit, it looks like this year things will remain the same on that end, adding that he's unsure how much further weights can be pushed. Question 3. Will poultry and pork production grow greater than expected? Dr. Burdine doesn't think so, but he also points out that pork and poultry production have the capacity to grow faster than beef, and they also compete on the meat markets. That being said, it currently doesn't look like there's going to be an expansion in pork or poultry this coming year. And the final question, will there be any trade policy impacts? Dr. Burdine says it's too early to truly tell what's coming, but he does reiterate that China, Mexico, and Canada are major trading partners with the U.S., and economic policy will affect import and export prices. Over half of U.S. beef exports go to Japan, South Korea, and China, but those are almost exclusively export markets. The uniqueness of each of these trading relationships makes discussion of trade impacts very complex, and something that will be interesting to follow this year.
Similar questions appearing in the row crop markets as well, and it's all too early to tell. But with prices moving as they are, market analyst Christy Van Anchizeth says with tariff talks combined with current stocks, looks like prices will continue to stay low.
I just think that soybeans are in this spot that's the mid zone, that if we come into this next administration, talk tariffs, and you continue to have that ideal situation in Brazil, you can see beans fall down to that $9.11 to even $8.55, which is not what we want to see happen, and that's futures prices. And we know that President Trump wants to get ahead of these tariff talks, and we've been through this once with China, so China knows kind of how to go about this. So I think those conversations hopefully can go better. I'm more concerned about the tariff talk that's being kind of talked about between Canada and Mexico and the U.S. than I am the ones with China. I think that corn actually has friendly statistics behind it. Your carryout of just over 1.7 billion bushel carryout is a decent carryout. It's, well below 2 billion bushel carryout. And after that December 10th report, I actually giggled out loud when I saw that our carryout level was much higher and corn was a good 30 to 50 cents higher than where we currently are. So I think the prices in general are very suppressed right now too. And so I think that you could justify that corn one. We moved on corn marketing over this last week. And one of the biggest things is that I feel like corn's going to have a hard time going at it alone, and I can't find the short-term friendly nature in soybeans and wheat to be able to support that corn market, and it's just been tricky for it to support itself. Yeah, for example, a couple days ago, you watched soybeans. They had like a 12-cent trading range, and corn had like a 3-cent trading range, but corn was consistently trading how soybeans wanted to trade. Soybeans traded negative, all of a sudden corn was down like a half cent. And then soybeans were able to find those buyers come in, and all of a sudden corn was up a penny. And so it just seems like it's tethered to that. And to be honest, they're completely different situations. Corn has friendly fundamentals, soybeans have disastrous fundamentals, especially worldwide. Corn's managed money holding. You have funds that have continued to buy corn. We'll find out what they did last Tuesday to Tuesday later, but they are long corn, where in soybeans they're short yet. And so I think they're just so different, they're having a hard time correlating together.
And that's it for a deeper look into the markets. Right now, prices reacting to stocks while demand not so certain, and Brazil's crop still underway.